I'm gonna review everything about the smart money trading strategy that made me over 6 figures in the past 1 year. This simple 3-step system has allowed my students to generate consistent profits in the market. And I'm gonna give it to you for free, cause I'm the GOAT. If you want to master this profitable strategy, you must be willing to watch this lesson from the start to the end without skipping around. Now, to keep things super simple, we are only going to be using 2 time frames. The higher time frame will be our 4-hour time frame, and the lower time frame will be our 15-minute time frame. So the first step is to build your higher time frame narrative. What we are trying to do here is to really come up with a story on what price is actually doing right now, so that we can identify our trade buyers. So the first question you want to ask yourself is price bullish or bearish? So we know that price will not just go up or down in a straight line. If price wants to go up, it will go up, pull back a little bit, and then goes up even higher, pulls back a little bit, and then goes up even higher. That's just how the market works, right? Nothing will ever go up and down straight. I know this might sound super basic, but people need to be reminded more than they need to be taught, right? So in an uptrend, we know that price is going to be creating higher highs and higher lows like what we have on the screen right here. So when price breaks through the last high, it creates what we call a break of structure to the upside, right? So this is our bullish break of structure. So if we were to map this up, we see that price is creating, like I said, higher highs, higher lows, leaving us a bullish break of structure. But we know that price will not go up forever. At some point of time, some sellers will come into the market and overwhelm the buyers. And that is when price will come down there and break past the last higher low. When this happens, this is our market shift. And then this market shift pretty much just tell us that price is reversing from an uptrend to a downtrend, and right now we are about to turn bearish. And if price is turning bearish, price will be creating your lower highs and lower lows, like what we can see on the screen right here, right? You can see lower highs, lower lows. Once again, it's creating bearish break of structure to the downside. And then eventually price will turn back bullish again when demand step into the market and overwhelm the sellers, and that is when we will get another market shift where price break past the last lower high, creating a new higher high, and now we are officially bullish. So this is just how the price move, right? This is just how the market works. That's the first thing you must understand, right? Is to really identify whether price is bullish or bearish right now, because we want to trade with the trend. If price is bullish, ideally we want to buy at all these higher lows, and if price is bearish, we want to sell at these lower highs. I know you're probably sick of hearing me repeat this like 1,000 times by now, but you must make sure you master the basics. Because if you don't, you are essentially building a house on sand. And if some natural disaster comes, it will just come and wipe out the entire house, right? So we need to have a solid foundation. The second question you want to ask yourself is price in the continuation phase or the pullback phase? Because after a break of structure, we know that price is going to start pulling back. And we need to have that at the back of our mind. And a lot of people don't, and a lot of retail traders don't. They assume that after price break through the last high, price is just going to continue going up like this in a straight line, and they start entering for a buy here, buy here, buy here, just for price to start pulling back. And then they are wondering why the market is going against them, so on and so forth. After a break of structure, instead of entering for a buy immediately, remember, we want to wait for price to pull back, and then we will enter for a buy right here. Because if you enter for a buy right here, guess what? Your stop loss must be below this last higher low, and your risk is essentially much higher compared to if you're entering right here and you have your stop loss below this last low. So that's the first step. You identify whether price is bullish or bearish so that you know exactly which side of the market you should be trading with. And then you identify whether price is in the continuation phase or the pullback phase. If price is in the continuation phase, I would advise you to wait for price to start pulling back and start to create that new structure. Then you enter for a buy. Because ideally, you want to trade with the trend after the pullback is over. So for the second step, we are still on the 4-hour time frame, and this is when you want to map out your supply and demand zones. In the last video, we have already taught you how to actually map out your supply and demand zones, and I'm not going to go through the entire thing again, but basically you want to identify demand zones in a bullish market, and you want to identify supply zones in a bearish market. Because these are the zones that are aligned with our higher time frame trend, and we want to be able to trade with the trend, right? So using this example right here, what we have was that price was going up, and then it hit onto some unmitigated supply zone that we have on the left hand side, and that is when supply stepped into the market, and that caused price to start turning bearish to facilitate the pullback, right? So once price starts pulling back, eventually it goes up there and break past the last high, giving us a break of structure to the upside, and now we know that we are in a continuation phase. Remember, when price is in the continuation phase, yes, you can enter for a buy here and here, but I would advise you to trade after the pullback is over so that you can get the optimum entry point. Eventually, price will start pulling back again. Once again, why is it pulling back? Because it hit some sort of supply zone that we have on the left hand side, and supply stepped into the market and caused price to start turning bearish. Now, once the pullback start happening, you will start to see price creating lower highs and lower lows on the lower time frames. And at this point of time, you must be aware of the higher time frame trend and know that we are just turning bearish for a short amount of time to facilitate the pullback on the higher time frame trend. So you cannot assume that price is reversing into bearish right now because price has not took out this last higher low. That means we are still playing within this swing range right here. This is a swing high, this is a swing low, and price is just turning bearish to facilitate the pullback. So in this case, since we are in a bullish market where price is creating higher highs and higher lows, we want to trade from demand zones, right? So based on this, we are able to identify two demand zones. This is the first demand zone that was being created after price broke structure, and then this is the second demand zone, right, which was created after price broke the internal structure right here on the lower time frame itself. So now our job as professional trader is to simply wait for price to come back down to either one of these demand zones, and then wait for our entry model to present itself, and then that is when we execute our trade without hesitation, reservation, or fear. So now this is where I would advise you to set the alert at the edge of the zone that you want to trade from. And right now you might be asking me, Brad, so which zone is price gonna respect and starts going up? Let me tell you the honest truth. I am not a fortune teller. I don't have a freaking crystal ball. I don't know which zone price is gonna respect. And the thing is, you don't need to know in order to make money. You just need to wait for price to come down to either of these demand zones, and then you wait for your entry model to present itself, and then that is when you enter for the trade. So step 3 is where you execute your trade after price has entered into your demand zone. So at this point of time, before we get too ahead of ourselves, you must be wondering, okay, are we allowed to trade right here where price has turned bearish to facilitate the pullback? Yes, you can. Right, so if you are looking to trade the counter trend, which means you are trading against the higher time frame trend, you are trying to capitalize on this short-term pullback that we have right here, yes, you can enter for a sell here at all these lower highs right here, but bear in mind, you have to manage your expectation, because the minute price enter into any one of these demand zones right here, we know that at any point of time right now, price is going to switch bullish and it's going to cause price to continue to go up. So the best way to trade counter trend, or rather the best time to do it, is to actually enter for a sell at the start of the counter trend itself. But the minute price enter into either one of these demand zones, I will advise you to stop trading counter trend and look for your pro trend setups, right? Look for your entry model. So if you look at this, there is a gray line right here on the screen and there's a black line, right? The black line basically represents the 4-hour time frame, and the gray line basically represents the 15-minute time frame, which shows us what price is doing on the lower time frame. And as you can see, like I said earlier, price turned bearish, right? It created lower high, lower low, lower high, lower low on the internal structure, on the lower time frame structure, in order to facilitate the pullback of the higher time frame trend. And like I said, we want to wait for this pullback to be over, demand step into the market, overwhelm the sellers, the supply that we have right here. That is when we know that right now the internal structure, the lower time frame structure, has shifted from bearish to bullish, and the lower time frame trend is aligned with our higher time frame trend, and this is when we are able to capitalize on those high probability trade setups. So in this case, right, what happened was that price came down into this recent demand zone, but it failed, right? So this demand zone failed to do its job, right? If demand wanted to step into the market, what could potentially happen is that price would just continue going up like this and just continue with the higher time frame bullish order flow. But that did not happen. This demand zone failed, and in the end, price went down even further and came down to our extreme demand zone. Now, bear in mind, this extreme demand zone right here, this is the last line of defense. Because if you look towards the left-hand side, this is the last swing higher low, right? This is the previous swing higher low, which means this point has to hold in order for price to remain bullish, in order for the higher time frame structure to remain bullish. Because what happens is that if price break through this last higher low, what we have is a market shift, which tells us that price is reversing from this uptrend to a downtrend right now. And I know my drawing is extremely ugly, but just bear with me a little bit because it will all make sense very, very soon. So knowing that this is the last line of defense, we can be a little bit more aggressive with our entry. So the minute price actually mitigates your 4-hour extreme demand zone, you want to drop down to your lower time frame to actually look for your entry model. Now, you might be wondering, what does the entry model looks like? Don't worry, I'm gonna give you the secret sauce right now. So this is what the entry model actually looks like. So we know that price has turned bearish to facilitate the pullback, and at some point of time, we want to see signs that this bearish trend is over. And right now, price has shifted bullish, and that is when we want to look for our market shift, right? So bear in mind, this is what price is doing on the 15-minute time frame, right? So you want to see price goes up there and break past the last lower high, creating a market shift, which signal to us that right now the order flow has transitioned from bearish to bullish. And right now, we are about to go to the moon. So that is the first criteria that must be fulfilled before you actually enter for a buy. The second criteria is you want to wait for some form of liquidity to be swept. You must understand that smart money, they need to sweep liquidity before they can cause price to start going up heavily. Now, if you don't understand liquidity, here's a quick crash course. We know that above every swing high, there is available liquidity, and below every swing low, there is available liquidity. Why? Because when a retail trader enters for a buy right here, that is when they will place their stop loss below this last low, right? So that is just available liquidity being built up. That is when smart money, sometimes they will push price down there purposely and manipulate price to sweep the available liquidity that we have below these lows before causing price to reverse and hit back up. And the thing about liquidity sweep is that it usually comes in a form of a sharp V-shaped reaction like this, right? You want to see price aggressively going out and aggressively coming back in. So what happened right here is that when price started reversing right here, right, this is when it will induce the retail traders to actually enter for a buy position, thinking that price is going to reverse right now, and that is when they will place a stop loss below this low right here. And that is when smart money come down there, sweep the available liquidity, stop them out, stop these newbies out, and then cause price to reverse and head back up. And that is when the real move is starting to happen. And that is what we have, a liquidity sweep. So after you get your liquidity sweep, after you get your market shift, that is when you want to be waiting very patiently for price to come back down to the demand zone that actually created this market shift. And that is when you enter for your buy position. This is where you get your optimum entry point, ladies and gents. So you can either enter for a manual buy order, or you can set an entry limit order on the edge of the zone itself, and then you need to make sure that you place your stop loss below the zone itself. Now, looking at this entry model, you might find that it looks very familiar. Why is that? Because what we saw on the higher time frame is essentially the same thing. This same exact entry model can be used on any time frame, be it the 15-minute, the 4-hour, the daily, or the weekly, whatever, because price is fractal. Whatever happens on the higher time frame must first happen on the lower time frame. Whatever happens on the higher time frame must first happen on the lower time frames. And the same pattern tends to repeat themselves over and over again. What's up, bro? So while editing this video, I realized that I made a little mistake in the drawing itself, right? So basically, I know you guys are probably confused. Why is this circles and then pointing to this thing? Basically, just know that you are looking for this entry model on the 15-minute time frame over here. Right, so there isn't supposed to be these little circles right here, right? The point of this is just to show you that, okay, there is a liquidity sweep. That's the second criteria. The first criteria is a market shift. And just wait for price to pull back to the demand zone that created this market shift, and you enter for a buy right there. As simple as that. Now, what this diagram is for those traders who want to analyze their charts on a 4-hour time frame, which means all of this will be on 4-hour time frame. And then once price mitigate the 4-hour point of interest, you will jump down to the 15-minute time frame over here, the minute it mitigated, and then that is when you look for this on the 15-minute time frame, right? But let's just keep this strategy super simple and just stick to what I mentioned, which is basically look for your market shift and your liquidity sweep on the 15-minute time frame, and then wait for price to pull back to the demand zone that created this market shift, and you enter for a buy right there. As simple as that. No need to overcomplicate things here, right? Yeah, so this is more of a like multi-time frame analysis, but nah, let's just put that aside for now. Alright, now that you have understood what I'm basically trying to convey, let's get back to watching the video. So now that you have understood our entry model, you will know that after price has mitigated our 4-hour demand zone, that is when we want to look for our entry model right here. But let's say for some reason you miss out on this entry model, right? This entry opportunity right here. What do you do next? You keep calm and collected and you wait for the next trading opportunity. Right, the next trading opportunity will come after price goes up there and create the market shift once again, breaking past the internal lower high, and that is when you wait for price to pull back to the demand zone that created the market shift, and this is when the minute price come back down here to this demand zone, that is when you go down to the lower time frame once again to look for the same exact entry model. That is why I say price is fractal, because the same thing just keep happening over and over again. And ladies and gents, this is where you are able to get the high from the trade setups, because now we know that the lower time frame is bullish, the higher time frame is bullish, and we got the multiple time frame alignment, and that tells us that right now we are about to go to the moon, and right now we are about to print some good ass money. So what's next after you enter for the trade? After you enter for the trade, this is when you want to manage your trade. And I'm going to show you the exact step-by-step process on how we actually manage our trade. First of all, you'll be placing your stop loss behind the supply and demand zone that you actually entered the trade on. And then for a take profit, I will advise you to either take profit at plus 3R, which means the minute price reach 1:3, like this, 1:3, you get out of the trade. Or you can take profit at the nearest opposing supply and demand zone. So in this case, if you are entering at a demand zone, right, we're entering for a buy at this demand zone, we want to take profit at the nearest supply zone. And if you're entering for a sell at a supply zone, you want to take profit at the nearest demand zone, right? So this is when you can potentially place your take profit at this nearest supply zone that we have on the left hand side that cause price to come down here. And yeah, that is another way we can take profit, right? So either take profit at the plus 3R or the nearest supply and demand zone. And I will advise you to go and find out what works best for you. Remember, data is king. You need to really gather data to see which take profit method works the best for you and then stick to it consistently. Once you place your stop loss, once you place your take profit, set and forget. Don't micromanage it whatsoever. Don't adjust your stop loss. Don't adjust your take profit. Trust your analysis. Because the minute you start adjusting your take profit, making it wider, or adjusting your stop loss, making it further, that is when you will start to incur large losses and small wins over the long run. And that's not what we want, because we want to be consistently profitable, which means we want to make a lot of money and lose a little bit of money. Now that you have understood our 3-step process, let's go on to the charts and apply everything that we have learned so far to see how we can apply this entire strategy in real time. Okay, before that, let me drink some tea. Now, how can you have a Trading Geek video without some tea? It's like Batman without Robin, or it's like having some fries without ketchup or chili. It just doesn't make sense. It doesn't exist. Your boy needs his tea, alright? Alright, so cool. Let's get onto the charts. So over here, we got a bullish break of structure to the upside because price created a higher high, higher low, and then this is potentially a new high. We gotta identify that this is the high until price starts pulling back. Alright, so that is when you can start seeing price starts pulling back. Okay, cool. That is when we got a new high right here. Now, remember, after a break of structure, we are anticipating price to start pulling back. And right now, we are still on the 4-hour time frame. We haven't dropped down to the 15-minute time frame to look for our entry yet because price has not gotten into our zone. Actually, no, we haven't even marked up the zone yet. Right? So we are still on a 4-hour time frame, observing what price is doing. Step 1, building the higher time frame narrative. Right? So at this point of time, we know that we are officially in a pullback phase and price is in a bullish uptrend. So we want to actually enter for a buy at a demand zone. But which demand zone are we trading from? That is when you want to start marking up your demand zones, right? So what led to this break of structure? There was this demand zone right here, right? This entire giant consolidation, and then demand step to the market and cause price to skyrocket, right? So we know that this is one of our demand zone, right? So in this case, this is the range method where we are marking up the entire consolidation, or you can mark it up, or rather just refine it to this pivot candle that we have right here, right? So that is your first demand zone. The second demand zone that we have is potentially this one right here, right? So once again, what do we have right here? Price started consolidating around here, and then demand stepped into the market and push price up, right? So you can actually mark the first one right here, but you can see price has just completely disregarded, so it doesn't make sense for you to actually mark the first one since price has already disrespected it, right? So that is when you mark up this recent demand zone, right? This is when we get a consolidation, demand stepped into the market, and boom, demand push price up. And then we also got our extreme demand zone, which is this one right here. What happened was that price came crashing down, right? And then it started reversing and start heading back up right there. So this is our extreme demand zone. So now we got 3 demand zones in place right here, and we know that right now we are playing within this swing range, right? This is our swing low, and then this is our swing high. So step 1 is done. The step 2 is also pretty much done because we have already marked up our demand zones, and we know that in a bullish uptrend, we want to trade from demand zone. And the next thing you can potentially do is to set alerts at the edge of these zones right here. So for those newbies who don't know how to actually set alerts on TradingView, you're a dumbass, no offense. You just need to go to here, press the alert, and then press this plus button, and it allows you to create alert. And that is when you just want to input the price point that you want the notification to be triggered on. And then once price get to that particular price point, TradingView will send you an alert in the form of either SMS or email that tell you, hey bro, right now price is at this price point, you can go up there and analyze the charts. That's what an alert does. And then the next step is to just do nothing and wait. And this is when so many traders mess up. They start taking a bunch of trades, they start forcing trades even though there is no opportunity because they are not patient enough to wait for the trade to come to them. Right? So at this point of time, let's just wait for price to mitigate either one of this demand zone before we determine the next course of action. Boom! That is when price came into this nearest demand zone. Alright, so at this point of time, like I said, this is where you want to drop down to the 15-minute time frame to look for your entry model. And if we don't get our entry model whatsoever, that means price is potentially just going to disrespect this demand zone and come down to the next demand zone, right? And then that is when we just continue waiting until eventually we get our entry model. We get the market shift that tell us that the internal structure, the lower time frame structure have shifted bullish. This is when you can potentially drop down to your 15-minute time frame, the lower time frame, and let's just observe to see whether our entry model present itself, right? Let's see whether this demand zone actually hold. Okay, cool. Nope. You can see it completely just blew right past it. So we know that this is not the demand zone that we want to trade from, so we can just delete it. Cool, let's go back up to the 4-hour time frame and continue waiting. Like I said, patience is the name of the game. This is what separates professionals from retail amateur traders. You guys just like to rush things because you want to get rich ASAP. No, just be patient, alright? So you can just wait. Price just blow right past this point of interest as well. But this is when we start getting some form of market shift. You can see, this is where demand step into the market and overwhelm the sellers, right? Just by looking at the candlesticks, we know that a lot of demand have stepped into the market. Cool, let's just jump down to the 15-minute time frame since price has already mitigated this demand zone, right? So let's just go down there, and this is when we want to look for the market shift. Remember, we want to see our entry model present itself, right? So over here, this is when we know that, okay, we got our entry model right here. Okay, so over here, price has already mitigated this demand zone, right? And that is when we are looking for our market shift. Now, how do we know the market shift has happened? We just continue to map out the internal structure, the lower time frame structure. We know that this is the internal break of structure to the downside, right? You can see price has just been creating a bearish break of structure to the downside, and since then this is the last bearish break of structure, right? So since this is the last bearish break of structure, we can identify that the highest point is basically this area right here. So this is the last swing high, right? So this is the last high, and the minute price actually broke past the last high, that is when we got our market shift. Remember, for a break of structure to be valid, the candlestick must close below the last low, right? So that is why in this case, right here, when price came down here, break past this last low, it did not close below it, right? It's just a candlestick wick break, so it does not count as a valid break of structure. So later on, price actually did close below the last low, so this is the last valid break of structure. And once again, to determine your last high, you just draw a box, right? From the last low to the point where it breaks past the last low, and then you just drag it all the way up there and you determine the highest point, which is this one right here. So this is actually your last lower high. And since price has just broken past the last lower high, that is when we got our market shift. That is the first criteria, right? So the first criteria has been met. We got our market shift. The second criteria is that we want to look for some form of liquidity to be swept. And once again, you want to ask yourself, where is the available liquidity? And remember, I said that below every swing low, there is going to be available liquidity, right? So based on this, we know that over here, where price came down into this demand zone and started reversing, this is when most retail traders, they will start entering for a buy position because they see price tapping to the demand zone, they enter for a buy and happy-go-lucky thinking that price is going to go up right now. And then they place their stop loss below this last low, right? So there is available liquidity below this low right here. And we know better than that. We know that potentially price is going to come down there and sweep the available liquidity before it started reversing. And that is when later on, price actually came down here, right? Reverse. And then came down here again, swept all the available liquidity below these lows right here, trigger out all the retail traders stop loss, and that is when price reversed and hit back up. You can see this is a very sharp V-shaped movement. Now, after this liquidity sweep, after this V-shaped reaction, what does this tell us? This tells us that the smart money, they have entered into the market. Now, as retail traders, we want to trade with the smart money. We want to follow their footprints. So this was the second criteria, was that liquidity sweep. So now that we got our liquidity sweep and we gotten our market shift, the next step is to wait for price to come back to the demand zone that actually created this market shift. So that is when you want to identify the demand zone that created this market shift, and it will be this consolidation right here. You can see this is where price consolidate here a little bit before demand step to the market and push price up. So this is when we know that, okay, cool, this is the demand zone that created the market shift, and that is when you can place your entry order, your buy limit order at the edge of the zone itself, place your stop loss below the zone. As for your take profit, like I said, you can either put it at 1:3R, which is somewhere right around here, 1:3R, or you can place it at the opposing zone, which in this case is a supply zone, right? So in this case, I will actually mark this up as the nearest supply zone. So this is our nearest 15-minute supply zone right there, right? So like I said, either place it at 1:3R or place it at the nearest supply zone, right? And now we just wait for price to come back down here to the demand zone and trigger us into the trade itself. Right, so you can see price consolidating, doing its thing, you're still being patient, you are trusting in your plan, and boom, that is when you get into the trade right there. So right now, your buy order has been triggered, you have placed your stop loss below this last demand zone. What next? Set and forget. You have placed your stop loss, you have placed your take profit, you have done your research, you have done your analysis, you have waited a few hours for this entry model to present itself. Now just wait for the trade to play out. Right. Once again, you can see this is what makes trading so hard. It's the waiting, the fact that you cannot do anything, and the fact that the market is an irrational, uncontrollable, unpredictable beast, and there's nothing you can do about it. So place your stop loss, place your take profit, set and forget. Let's see how this trade play out. Boom. There we go. As simple as that, ladies and gents. Now we have hit our take profit. We can go pop a nice champagne or so and call it a day, and then reset and look for the next trading opportunity. Now, once again, why is this considered as a high probability setup? Because the lower time frame right now has turned bullish since we gotten this market shift, and the lower time frame is aligned with our higher time frame trend, which is bullish. So if you want, you can even be more ambitious to target this 4-hour swing high. But I wouldn't recommend you to do this unless you have a lot of experience, because what can potentially happen is that price can start to turn bullish and just goes up like this and reach this supply zone right here, and then it starts coming down and just continue to consolidate around here. That is when I don't want you to be stuck in this little consolidation for weeks, right? I just want you to get in and get out of the market fast, but not too fast. And yeah, that's basically how you utilize this 3-step simple system. So now let's say for some reason you actually didn't manage to get your entry here. What's the next window of opportunity? The next window of opportunity is once again to wait for price to pull back. Because right now we know that right now price has turned bullish, right? And we know that this is our new higher high and this is our new higher low. And right now price has just created another bullish break of structure to the upside. And after a break of structure, we know that price is going to start pulling back. And where is it going to pull back to? It's going to pull back to some sort of demand zone, right? So in this case, this is the entire demand zone that led to this break of structure, right? So that is when you can place another buy order right here at this new demand zone, and then simply wait for price to come back down, mitigate this area right here, and that is when you enter for a buy. It's the same thing. Like I said earlier, price is fractal. If you look at this, we literally did the same thing on the 4-hour time frame, right? So you just wait for price to come back down to this demand zone that created this break of structure, and then for you to get triggered into the trade. So in this case, just wait. Boom, that is when you get triggered into the trade right here at the edge of the zone once again, and you place your take profit either at plus 3R, right, like what we've done right here, plus 3R, or at the nearest supply zone, which will be this supply zone right there. And then just wait for price to play out. And there you have it. As simple as that, guys. I'm literally not kidding when I say that this is how you really capture those high probability setups, right? Because what happens is really the lower time frame right now is bullish, the higher time frame is bullish, and that is when we are able to capture these nice setups. So if you still don't get it, I would advise you to rewatch this lesson over and over again until the concepts get embedded into your subconscious mind. And then that is when you are again one step closer to mastery. So in the next lesson, I'm going to show you the exact blueprint that's allowed my students to become 6 figures funded trader. They are able to pass 100k funding challenges with ease using this exact strategy, right, which I'm going to review in the next lesson. So if you don't want to miss out on the next lesson, make sure you scroll down right now and turn on post notification by pressing the freaking bell below. And I sound like a stupid YouTuber right now, but yes, you need to do that in order to get notified when the next lesson drops. And if you still don't understand supply and demand, please go and watch this lesson right here. And as always, remember, you're just one trade away.